Traders, welcome back. It's John, and here's another GMU Extra. In this episode, we're going to look at cheap and expensive. So my suggestion is to delete these two terms from your vocabulary completely. They're relative terms, and they really mean nothing. The reality is that in the markets and stocks, they sell at fair value twice, once on the way up and once on the way down. You can also stop thinking about using terms like overvalued, undervalued, overbought, oversold. The reality is the market works on the laws of supply and demand. The question is, will someone pay more or less for this stock later? So a seasoned trader's mindset never looks at things as being cheap or expensive. Price is what pays. So how do you think about price? Do you use terms like cheap and expensive? Do you focus on price to earnings ratios? Do you give weight to other people's opinion about their opinion on what's cheap or expensive? Do you value the number of shares that you own? How about absolute numerical changes? Do they really matter? $1, $2 of a stock's price? So let's look at this in detail. Here's a situation with Booking.com in 2010. It's a weekly chart. Stock comes out of a base. My broker got me in here at $80 per share. Great buy. Stock moves up. My broker calls and says, it's time to sell. This stock is very expensive and overvalued at $120 per share. I have a good gain, so I sell. Now this stock formed another base and the stock breaks out again. But this individual to themselves says, I can't buy it now because my broker says it's, quote, expensive. Well, they missed out on another 100% move in the stock because their mindset was biased by these terms. Here's Aurora Cannabis from 2019 to the present. Back in 2018, the stock peaked out at $140 per share. As the stock came down in price, a couple things happened. There were two big volume days and the stock moved up. There was actually a reverse stock split helping that move. Individual says, it's coming back on huge volume. I'm looking to buy cheaply. So I'm going to buy this bargain because it's so cheap. It's only $20 per share and it used to be $140. Well, the stock continues to move lower. Gets another volume spike in a wide range bar. Oh, it's coming back again. I'm going to double up my shares now because it's a real bargain and cheap at $10 per share. The stock continues to move lower down to $5 per share, at which time the individual is really stuck with the stock. I'm just going to have to wait it out, but don't worry, it'll come back. Well, here we are in 2023. The stock is in the neighborhood of 60 cents per share. It's never come back. Another example is America Online in 1998-99. After the 98 bear market, AOL formed a cup with handle and broke out in October of 98. The PE at the time was 205, which was terrifying to some investors and seen as really, really expensive. Well, the stock went on a tear. By April of 99, the stock had gone from $32 a share to $175 a share in only 15 months, over 400% gain. And the PE went from an absurd 205 to 532, an expansion of the PE of 160%. So never use the PE with a growth stock and where it could possibly go. Here's Tesla from 2020, one of the biggest winners coming out of the COVID bear market. It was constantly shrouded by analyst downgrades citing PEs. When it broke out in June of 2020, it had a PE of 139. A few months later, the stock had actually over doubled, and the PE was now 272. Downgrades were appearing everywhere as the stock was too expensive. The stock based again, got added to the S&P 500, and made another leg higher amidst downgrades. and the PE expanded to 348. The point of showing you this is you can make a lot of money on, quote, expensive stocks. Here's Tilray. It IPO'd at $17 per share back in 2018, and it had an explosive move to $100 per share, and many people said it was expensive. Well, it kept going. It actually peaked at $300 per share, and anywhere in this range, this one bar, everybody said it was expensive at $200 a share. Well, the stock went into a steady downtrend. And way back at March of 2020, the stock actually traded below its IPO price at 17. Some people thought it was incredibly cheap to get Tilray below $17 a share because it was below the IPO price. You can see that $17 got a whole lot cheaper when it dove to $3 per share. The point of showing you this one is you can lose a lot of money on, quote, cheap stocks. Now, I've mentioned also the words oversold and overbought. Chris Shavako did an analysis of a rare signal that occurs in the market. And it's a signal of when the NASDAQ 100, the percentage of stocks in the NASDAQ 100 are above their 150-day simple moving average. When you get a sharp move from being in a very oversold condition in the red box, and it spikes up to an overbought condition in the green box, that's a very rare signal. It's only happened 5 times since 2000. 03, 09, 12, 2019, and 2020. Well, that signal has just occurred from an overbought condition, extreme oversold in 2022, and we've now just triggered the signal of being overbought in 2023. So as the chart shows, the market is clearly overbought and considered expensive. Well, Chris looked at this rare signal and said, well, what happened after the signal? What were the returns like? Well, here's the 1-year, 3-year, and 5-year returns. And you can see they're positive 100% of the time, and they're very satisfying returns from an average of 25%. And when you go to 5 years out, they're over 100%. And don't forget, these returns are after the signal when people are started to label this as overbought or expensive. So the point is, these terms can bias your thinking, and you really don't want to have these in your vocabulary and affecting your mindset. Now, the mindset of a retail trader falls prey to a number of other psychological myths. Retail traders prefer low-priced, low-quality stocks, typically under $10 a share. They also overvalue round numbers of shares to be purchased. They want to purchase round lots of 100, 200, or 1,000 shares. And they think that's more important than the dollars invested. They have a mindset of saying, I want to buy low, I want to buy in the cheap, and I want to sell high. So they're always looking for these bargains on the cheap. While the reality is the best merchandise in the market, the best stocks have the best earnings, the best sales, good products, good services, driving their growth. And they don't sell often on the cheap. So let's look at this from an investment point of view. If you had a $50,000 account and you wanted to invest $10,000 into a stock and have a 20% position size, you have 2 options. Chipotle is selling for $1,250 per share, and at $10,000, you can only buy really 8 full shares. Upwork only sells for $10 a share, so you can buy this nice round lot of 1,000 shares, but it's the same dollars invested, $10,000. Many retail investors would be impressed with owning 1,000 shares of something versus saying, I don't care about the share price and how many shares I have to buy. It's a dollars investment, and I want to pick the best investment. Now, both stocks move up 30% in price. CMG moves to $16.25 times your 8 shares. Shares are now worth $13,000 for a gain of $3,000. Upwork similarly moves up from 10 to $13 per share, a 30% move, the gain is exactly the same, $3,000. Has nothing to do with number of shares that you own. It's the percentage gain and what you invested. So absolute price movements can also be irrelevant. You really want to think in terms of percentages, because a $4 move in a stock that trades $1,250 per share means nothing. It's only 0.3% move, where in Upwork's case, a $4 move is huge. It's a 40% move. You'll never hear institutions speaking about how many points a stock is going to move up. They always used the valuations to forecast movements. For instance, they'll say, this company, which currently is selling at a $10 billion valuation, they believe it will go to $25 billion valuation within, say, 3 years. So you always want to think in terms of percentages, percent gain on the day, percent drawdown, percent loss, and position sizes as a percent of your overall account equity. $10,000 is a 20% position size of a $50,000 account. No one should care about how many shares you actually own. So cheap and expensive are dangerous terms. They're relative terms, and they really mean nothing. All they do is they can cloud your mindset and actually potentially prevent you from taking advantage of opportunities in growth stocks. The bottom line is the market's all about supply and demand. Will someone pay more or less for this stock later? That's the GMU Extra on cheap and expensive. We'll see you on the next one.